Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel and all the comments and subscribers. I'm really digging going through the comment section and responding. For those of you who are new, welcome to the Rational Investing Show. This is where we look at cash flow investing as the underpinning for all assets, and that's how we derive the value. We try to find what is that value and what we think it's going to be in the future, and look at the divergence and assume that when that's realized, that's our economic return. And we use 5 key attributes to value all investments here at this channel. First is top line revenue growth. Second is EBITDA growth. It's enterprise level earnings, EBITDA growth. We want strong free cash flow. We want a solid balance sheet with less than 3 times debt to EBITDA. And you want a well-priced stock. You don't want to pay too much for cash flow. That is what value investing is about. That's what we try to do here. Sit back, wait for the market to panic, and then jump in when everyone is selling. That's when we want to be buying. So let's dive into it. You're watching this video because you wanted to take a look at Barrick Gold. We're going to go through it and figure out primarily why did Warren Buffett buy Barrick Gold after denouncing gold his entire investing career to suddenly take a position in a gold company. What's going on? Why doesn't he just buy the base metal? I'm going to give you the answer to that. It's a very interesting one. It's one that we harp on here constantly on this channel, and we're going to dig right into it. The answer for that question, why Warren Buffett bought Barrick Gold and not just the gold itself, is on page 64. This is the 10K for Barrick Corporation. Fiscal year ends December. This is a 2019 financial report. What they did, and this is, kudos for them for doing it, they tell you with every dollar that gold moves, you can have X incremental growth in EBITDA of the company. So it's right here, gold revenue, net revenues, right? Their 2020 guidance, they're using $1,350 an ounce for gold, and they're saying for every incremental $100 per ounce of gold, either $100 up or $100 down, there's a commensurate impact to EBITDA of $472 million. That is exactly what Buffett used. I'm sure a number of other things, and other people have gone through it on YouTube and talked about the asset values and reserves and so on and so forth. But realistically, he's a cash flow investor. He thinks gold is going to go higher because of the money printing that's happening in the United States, and he might be right. And he's looking at that and saying, you know what? That's kind of like a nice call option on the dollar, on gold. And for every $100 that gold goes up, this company generates an incremental $472 million of EBITDA. Okay, let's take a look. We're going to actually go through this. We're going to show you 8 years or 9 years of financials and 9 years of cash flow historically. Then we're going to say, well, what happens if you move the gold number? What does that do to enterprise value? What does that do to growth? What does that do to return? And it's going to be fascinating. So watch this. Let's start, as we always do, with revenue. Take a look at revenue and see what has it done over the last, this would be 9 years. 2011 to 2019, $14 billion of top line revenue to $9.7 billion of revenue. That is a decline of 5% annually. And you can see during that time frame, I've got gold here off to the side, and this is rough numbers on gold. Bear with me. I just kind of looked at a graph, put kind of average marks for the fiscal year, and you can see gold came down quite a lot during that time, only recently spiking. It's currently sitting around $1,900 an ounce, but for the most of this time, gold's falling. Makes sense revenue would fall commensurate. Let's look at EBITDA. EBITDA, the same story, 8.5 billion to 4 billion, decline on a 7.6% average. No shocker there. Let's go look at the enterprise value and see what happened. Debt, which is nice to see, debt came down with the following EBITDA. So debt's $13 billion to $5.5 billion. They've got no excess cash. Market cap's roughly flat over this time, slightly down, $47 billion to $31 billion. And an enterprise value again, debt plus market cap, less excess cash. There is no excess cash. So it's basically just adding these two up and you get the enterprise value. Enterprise value went from $60 billion to $36 billion. So a decline in the enterprise value. Refresher. What is enterprise value? Enterprise value is the entire value of the company. Think of a home, a house, for example. If you are trying to buy a home, you go to the bank and get debt. You've got your down payment, which is your equity. In this instance, the equity is the market cap. The debt is the debt. So when you think of a house, a home price, what it sells at the enterprise value. You have to pay down the debt, and what you keep is the equity. Same thing here. Here's the equity, here's the debt. When I want to buy a business, I'm buying at the enterprise level. That's what we look at. What is the entire business worth? And what is the entire business's earnings, which is EBITDA? We divide the two, we get a metric for value. And what you'll see is that the value for Barrick Gold on its cash flow has been very, very low. It's single digits. 7.1, 5.7, and then recently it's gone from 8.1 to 12.5. So it is definitely moving north as gold has gone from, let's see, $1,400 to $1,900. You're seeing an expansion in the market multiple from 8 to 12 because people are expecting future cash flows to be higher because gold is higher. Makes sense. Okay, fine. Last metric we want to look at, debt. Debt is shockingly low for such a big company with such a heavy asset load, right? All the machinery and equipment that it takes to mine this ore out of the ground. I would expect them to have a whole lot more leverage than they do. They don't, which is nice. They're at 1.2 times leverage. We look for anything less than 3 times, which is fantastic. So I think for us, the debt side checks the box. The valuation seems low currently. Revenue and EBITDA are declining. Neither of those check the box. Let's look at free cash flow. Free cash flow 2011 to 2019, 5.3 to 2.8 billion, down, right? Down 8%. That decline in 8% follows along with the decline in EBITDA of 7.8% or 8%. That means that the accounting department in Barrick Gold is reflecting cash expenses properly as they relate to the P&L, that they're matched. They're not trying to play games with the accounting and not book costs as they come in. That's a good smell check that the numbers are being accounted for properly. CapEx, as we expected, CapEx is going to be heavy and intense to keep the mines open and running. So you look at free cash flow last year, 2.8 billion. They put more than half of that back into the business, 1.7 billion, which left very little free cash flow for investors. Right? You got a little debt payment here, 300 million. And what's left is $823 billion. That is what the company has discretionary that they can use to pay dividends, to buy back stock, to make acquisitions, to do whatnot. And you'll notice that apart from 2011, this number has been negative that entire time. Let's go back and look at gold, see where gold was. So here, gold is $1,500 an ounce. It declined and earnings go negative to $1,900 where it turns positive again, or excuse me, $1,400. That's the fiscal year's $1,400. It's currently $1,900. What this is saying is that they have been negative when it's below $1,400 a share of gold, and it's positive right at $1,400. And as it goes to 19, and if it goes higher, they're going to mint more and more cash. And the tune of cash that they're going to print is this $4.5 billion increased by $472 million for every $100 movement of gold. That is what Warren Buffett is looking at. And he's buying this business, not the gold, because he wants the cash flow while he waits for the gold to rise. I'll show you what the impact to IRR is in a second. It's really, really interesting, and I think this is why he buys companies, not commodities in general. But let's finish out our cash flow to get rid of this thing. So then here is then the shares outstanding have grown. This is how they have funded their operations. If they're losing money for so long, you're like, well, what happens? How do they maintain the business? Where do they get cash? They sell shares. So as they're selling shares, shares are increasing the number of shares. They're using this cash to fund these operating losses. Well, essentially, they just hold on and wait for gold to grow. That's all they're doing. And so it finally hits. Now the question is, they're profitable. What happens to gold in the future? We're going to take a look. I just finished out the sheet here with average share outstanding and then a yield by dividing the free cash flow per share by yield, and you get a yield. But it's all negative, mainly because the business declined for almost a decade, waiting for an inflection point in gold, which has finally happened. Whew. Okay. I think it's the fastest I've ever gone through the historical finances for any company because I want to get to the good stuff which is the future. All right, this is right here, basically what I read to you in their 10K. They're saying, hey, their production for 10 years, they want to do 5 million ounces of gold mined annually. I actually think recently they said that's going to come down a little bit and the stock took a dip. Might be an interesting time to buy, but let's see what this says. 2020 guidance. Gold price $34.50 per ounce, plus or minus $100 movement in gold equals $472 million of extra value. Let's do this. Let's pick some numbers for gold. I don't know what's going to be, neither do you. Let's pick some numbers. So I've got gold here, $1,500, $2,000, $2,500, $3,000, $3,500, and $4,000 per ounce. The only assumption I'm going to make here is that it's going to go up. I don't think it's going down, but I have no idea how far, so I don't know. And I think that's kind of how Buffett approached it. He's like, I've got a stock portfolio that's in dollars. I'm not selling the stocks, but if gold were to rip up because of inflation, I want some participation to that upside, and a great way to do that is to buy a stock that mines the asset that's being upsided. This is the change in the guidance. So this is their assumption. Remember, the EBITDA number says their assumption is $13.50 is their guidance. Every $100 above this number means $472 million of extra EBITDA. So this is the incremental difference. This is $1,500 an ounce minus $3,500. Gives me $150. And I do that each instance, and this is the incremental add. Then what I do is I divide it by $100, so I get a turn multiple. So this is 1.5 times the 472 million. I'm going to be able to add to that EBITDA. So my EBITDA adder, I'm going quickly. My EBITDA adder is $708 million. Now I'll pause just to touch on this before I drag it down. All I did here is 1,500 ounce of gold is $150 above the forecast number. If I know that every $100 movement is that's basically 1.5 times this 100. There's my 1.5 times. 1.5 times my 472 gives me the 708. And I do that all the way down the scope here. So you can see, if I do $2,000 a share, I'm going to add $3 billion to last year's EBITDA. If it hits 4,000 an ounce, I will add $12 billion to the EBITDA. Now that's great, because it's just kind of a one-for-one for gold. Well, just buy the gold, because the gold in this instance would have doubled. If I took $2,000 an ounce per gold and I get $4,000 an ounce, I doubled my money. Great. So why buy the stock? Here. Companies trade at multiples of earnings, EBITDA, multiples of cash flow. You get a multiplier effect when you buy a company and that company produces free cash flow because it trades at so many times earnings. That's going to happen here. Here's my adder. If I look at this EBITDA, 4.5 billion in fiscal 19, and I add this column to that number, I get a long-term EBITDA target based on my different gold numbers, depending upon what it's going to happen. And as we know, companies trade at EBITDA multiples, right? You can see that right here, my enterprise value to EBITDA multiple for Barrick historically has been around 6.5 times. Recently, it's 12.5. I'm going to peg it to 8 just for fun. So here's your 8 times market multiple. Enterprise value is just my EBITDA, my long-term EBITDA, times 8 gives me an enterprise value. With me still? And then less the debt. Debt is fixed, doesn't move, right? It's the same number we have in fiscal 19, but EBITDA shoots up because gold has moved. It doesn't take more debt with the same assets they have to mine the same volume of gold. So what does market cap do? Market cap goes from $36 billion to $130 billion when gold goes from 1,500 to 4,000. Shown a different way, if I just peg these two lines here, gold doubled here. $2,000 an ounce to $4,000 an ounce. Market cap, 55 billion to 130 billion. So you got a doubling of gold is 2.5 times market cap. So you get a magnifier, multiplier effect on the share price. That's why Buffett, one of the reasons Buffett bought a stock and not the underlying asset, because the compound nature of earnings would mean the enterprise value or the market cap of the stock will be higher as a result of the higher EBITDA. Let's forecast forward and go through an IRR to see what does it look like if you bought it today. I'm going to peg the $4,000 as the long-term target. It's a lofty target, I get you. You can always pull it back if you think, but the numbers need to work at this price. You gotta shoot for a high number, otherwise it's the EBITDA, the IRR isn't there for holding it. But I do think actually gold is going to go up, so I'm going to peg $4,000 a decade from now. $4,000 gold produces, with the multiplier effect off the EBITDA for the 2019, gives me $17 billion of EBITDA long-term target. So I put that out over a decade, and I said over a decade they're going to go from $5 to $17 billion. Is it a decade? I have no idea. It could be 2-3 years from now, in which case the IRR gets even larger. But because I have such a long time horizon here, you have to think gold is going to go a whole lot higher to make economic sense. And it's a diversification play, so that's kind of what I'm using. But you can put your own gold forecast. This is just an assumption to show you how it works. Basically, I get the long-term forecast. I give it a market multiple of 8 times. You saw that before. So that means an enterprise value of $136 billion, less some debt, which is just a ratio of that I'm holding constant, the ratio in the past, gives me $91 billion market cap, less the existing shares of 1.8 billion, gives me a $51 price target. If I do the same thing for free cash flow, basically take the growth rate that's going to be produced to get EBITDA to go where it is, and I grow free cash flow the same way. I go from 53 cents to $1.74. I gave it a 2.5% free cash flow yield to give it a little bit of a premium, and it's a $69 price target. Here we go. Here's your forecast is $60 per share out 10 years, or whenever gold basically gets to 4,000 an ounce, if you believe that's the case. And then if I put that into an IRR, I get $28 in buying the Barrick. I get free cash flow as it slowly over time grows to 4,000 an ounce. I exit 60. That's an 11% IRR over time, over the decade. Now, if that happens in 3 years, then it's going to really boost the IRR. But we look super long-term because we just don't know. So I think that the timing here of when this happens will definitely impact your IRR. The sooner it happens, the higher this number goes. The longer it takes, the lower. Now, more to the point on the IRR for just holding gold versus not. So here it is. If I bought gold at almost $1,900 current price, which is, I got current price in the stock at, what was that? $28. $1,800 is the current gold. So if I bought in today, either the stock or the gold, and I held it for 10 years and sold it at the $4,000 mark, there's no cash flow from holding gold. It's just the in and out of the metal. That's a 9% IRR over that decade of time versus the 11% over this decade of time. The difference obviously being, one, the cash flows that you get over time, you're getting something while you wait, and two, that market multiplier adder that you get by taking the EBITDA and multiplying it times the 8 times. Those two will give you a little bit extra of return, and I think that is why Warren Buffett decided to buy a company rather than the base metal. He still wants the protection of the kind of inflation protection, if you will, that gold represents. But because he's a cash flow buyer, he's going to buy an entity that turns that growing commodity into dollars that he can use to reinvest. So this is a quick one on Barrick Gold. I hope you like it. I think this is why investors are buying gold companies for the cash flow rather than just holding the pure metal. I actually do like this company. I'm going to give it a good rating, right? Why? Because I do think we're going to experience some inflation going forward. The Fed has said it, obviously, so holding this is a good thing. We've had so little inflation for so long, I think we're kind of underrepresenting what inflation can do. And so for a small piece of your portfolio, it does make sense to hold some gold or some non-dollar denominated asset. I'm also personally holding oil stocks. I think they're cheap, and the oil itself is kind of a commodity hedge on the dollar, just like gold is. Let's recap quickly the 5 key attributes. So top line revenue growth is a miss. EBITDA growth is a miss, historically speaking. Free cash flow is not there historically. Cheap, yes it is. No debt, yes it is. So why would it get a good rating if it does not have those 5? Because it's price dependent on gold. What we know is that if gold goes up, that instantly reverts and becomes cash flow positive. You saw that in the 2019 numbers. The company clearly gives you a nice metric for every dollar of $100 of gold that goes up. What happens to the earnings, which is what we're buying in cash flow. And if our assumption is that gold is going to go higher from here, we just don't know how much higher. There's a reasonable degree of certainty there that the cash flow will be positive, that earnings will grow, and that revenue will grow. So that's kind of what I'm leaning on, is that forward look of gold. So I hope you like this. Let me know what you think. Comment, subscribe. I really appreciate all the time on the channel. Thank you all very much. My name is Cameron Stewart, CFA. This has been Barrick Gold. Thank you. Have a great day. Bye-bye.